Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is covered calls and short puts. And boy, the markets are choppy right now, bouncing all over the place. And that volatility to some may be opening a possible window of opportunity for the selling of options. So that fits right in with a theme for this webcast series. We're going to be talking about searching for short options income strategy candidates. We're going to be building a custom search today to look for specifically short put candidates. Should be an interesting discussion. Before we can get to that, though, let me first of all say hello to everybody who's already chatting in. As always, great to see all the familiar names. Great to see anybody who's here for the very first time. But hello there, Tony and Eva, Becca, Bruce, Mark, Jay Camacho, Marquise. Who else is here? Will and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy that recording. It's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, I also want to let my live stream audience members know that my very good friend Barb Armstrong is going to be hanging out in the chats with us. She's already been chatting with some of you already. She'll just be keeping an eye on any questions that come in, and if I can't get to those, Barb's there to pick up my slack for me. So thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody watching to follow us on social media. You can follow us both on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. You can also follow us on LinkedIn. But let's get into this discussion. As we do, of course, there are risks associated with covered calls and short puts and other strategies and investment approaches, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Pardon me. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. Very first thing that we're going to do, as we always do, is take a look at our existing positions in our paperMoney portfolio, see if anything needs to be changed there. I think there's interesting stuff happening there. But then we're going to take a look at market conditions. Very interesting market conditions. We'll see what's going on with stocks. We'll see what's going on with options and their associated premiums. And then we're going to plan and place a trade, but supplement that effort by constructing an example scan or a search for short put candidates. Should be a fun discussion. Let's go right to it. Mark says, let's talk premiums. That's what we're going to be doing, Mark. Absolutely. So let's go right to the thinkorswim desktop. This is the paperMoney platform. That's an important point because we actually are going to be leaving paperMoney. When we conduct our scan, we're going to be going over the live platform because I'm going to be using a tool that's only available on the live platform. In any case, we have 5 current positions, starting off with Apple, which is a covered call. Right now, we're in a 20th of March 280 call. So the preference here for a trader looking to retain ownership of their shares might be for Apple to go up, but to stay below 280. Well, it's below 280. But it hasn't been doing a great job of going up, very much like a lot of stocks out there. So here's Apple. Here's the history of Apple. By the way, as you look at our profit or loss since we opened these positions, right now it shows that across the range of our investments at the moment, down $1,000. Now, what we need to be aware of is that each one of these trades, with the exception of Walmart, has its own history that's not built into these numbers. So I'll bring you up to speed on that, but let's go to the charts. Here's Apple, and its history includes previously selling 2 puts that just expired for $2.77 profit per share, about $550 of profit realized there. We sold some additional puts. Those were assigned, but leaving with a realized gain of $540 on those premiums. And then we sold a call that expired for a profit of $220. And finally, we've sold most recently into a call Oh, by the way, sorry, I miscalculated here. There was only one put that we sold where we collected a 270 premium. That was a realized gain, so not 540, but $270 of realized gain there. Anyway, sold a call here that realized a profit. All of those realized gains are not reflected on the PL open when we're looking at that on the monitor tab. But most recently, we sold the 20th of March 280 call for $2.52. Now that was done. When we look at these lines, that tells us where we started our contract and when we might be ending it at the latest. So if we look at this, we started here when prices were closer to 280. Since then, the price of Apple has retreated. Yeah, Dan says PL means nothing to me until it's closed or assigned. That's right. That's why we call it a paper or unrealized gain or loss. Until action is taken, it's only a moment in time, right? It can go up or it can go down from that point. But let's go have a look at what's going on. What I suspect and what a trader might note is that when price has fallen like this, it's not great for the shares, which we do own, but it may allow an opportunity to get out of this contract that we're in where we've collected 252. If we go look at our monitor tab, that contract has fallen from $2.52 to just 22 cents. This is more than 90% decayed away. So what do we think we ought to do here? Trader could just stick with it, see if we can get the rest of the 22 cents, or maybe they close out this covered call and sell another one. And I think that's what we're going to do today. All right, let me go back here and look at our charts one more time. Yep, no earnings announcement around the corner. How about if we push this one out? Let me add some more space. I'm going to click on the little right expansion settings. Let's change that. So we're not just seeing 10 extra bars of space off to the right. Let's maybe crank this out to is 20. I think it's going to be about 27. Click apply. Not quite enough. Let's go for 28. Nope. 30. There's that April expiration. That's what I was looking for. So that's 30 trading days off to the right here. And what if we were to look to sell? I wonder if we could stick with that 280 strike, but push that out to April 17th. I wonder what that's trading for. I don't know. Let's go have a look. 17th of April, sticking with those monthly contracts can sometimes provide greater liquidity. Monthly contracts tend to be more heavily traded. All right, so the 280 calls are trading for about $1.64 to $1.69. If the trader's looking to get closer to 1% of the current price, we might need to put that to the 275 strike. Should we do that? Dan, you're saying buy it back? Yeah. How about we buy back the March contract that we're in, and instead roll that out out to the April, bring it down a bit to the 275. So on the chart, it would look like this. So our new level is going to be about right. Let's draw that in. Not as much upside, not as much wiggle room to the upside, but we're going to sell somewhere around there. I'm going to be a little bit finicky. Let's edit the properties of this. And what is the day? Today's March 9th. Let's start this line on the 9th. Let's put that out to April 17th. And let's make it precisely $275. And if I change the color scheme here, I like to just use red just to indicate that I sold to get into a contract. There it is. So that's just drawing a line from today out to expiration. And let's go to our trade tab here. Actually, let's go to our monitor tab. Let's do it from here. So on our monitor tab, if we're looking to close out the 280 and then go out to that April 275, let's right click on this one and create a rolling order. And off to the right, it's going to say we're going to be selling a calendar. Do we want a calendar? It's actually not a calendar, but a calendar just consists of buying and selling a call at the same time, which is what we're doing. It's just that we're buying to exit the one that we're in and selling to get into a new one. So let's change the one that we're selling. So this is going to put it in order to buy back the 20th of March 280 call that we're in, but it doesn't know which one we want to get into. So let's change this to the 17th of April 275 call. It looks like we might be able to get about a 243 credit. Let's say we're willing to settle for as little as a 240 credit. to close out the one and get into the other. I'm going to click confirm and send. See if we can get this quickly filled. Now it's going to say selling the diagonal. In any case, it's buying back the 20th of March, selling out to the 17th of April, going to a lower strike, trying to get a credit out of this. There is a commission to be paid to close out the one and get into another. But let's send this order off and see if we can get this quickly filled. Let me go to the monitor tab. Oh, it did fill. Okay. So if we want to see the details of that, we can go to the filled orders and see that we paid 23 cents to close out the one, collected $2.65 when we sold the other, bringing us a net credit of $2.45. Great. So we're done. So it can be done says, what's the logic between changing 2 to the 275 strike from 280? The 275 is closer to the current price, so there's not as much wiggle room to the upside. That's sort of a con. But the pro there is we got a bigger premium. It looked like the 280 was offering like $1.60 and change. The 270, as we see, got us 260-ish, a little bit more. So that was it. Going for a bigger premium, bottom line. All right, but there we go. Now we're in that 275 call, and we'll see how this one goes. So this becomes a realized gain. And I'll update all these numbers after the webcast is over, but you've seen the trade placed. Let's go look at our other positions. AbbVie, another contract or another covered call. We're in 200 shares. We've sold the 20th of March 240 call. Here's the history of AbbVie. So we bought 200 shares, sold some calls, they expired for a profit. Sold some more calls, they expired, or we closed those for a profit. I think between the premiums and the dividend that was collected, AbbVie, we have $925 of realized profit here that's not being reflected on that monitor tab. We've sold the March 240 calls for $1.65. Stock is peeling back. The calls value has gone down, but there's still 68 cents of premium left there. I think I'm going to leave this one to work for another week. Amazon, we own 100 shares, sold the 220 calls for March. This one also has a history. So with this one, we sold some puts originally, and these just expired worthless. We realized a profit there. Oh, no, I'm sorry. No. We sold those puts for $370, closed one out for a $303 profit, closed the other one out for a $365 profit, and then we sold some more puts, and those were assigned. Now, this one hasn't been going as well. This is one where we have some realized gains on the premiums, but we also have a realized loss on 100 of the 200 shares that were assigned. So we were assigned these shares at $235. That's our purchase price on our stock. And then the stock just cratered. We sold 100 shares as we broke below support right here. Sold 100 shares at 204.40 with the plan that if the next level of support broke, we were going to sell the other 100 shares, and it didn't break. It started to rally. We've sold a call against the remaining 100 shares, and boy, it came right up. How high did we get? That hit a high of 220.47, so right up to our strike, and then we've been peeling back from there. So we haven't broken this support. We're not going to sell the shares. I don't think, let's see, what are the calls? Yeah, the calls have only gone down a little bit in price. So I'm going to let that continue to work. Can be done says earlier call away missing on potential $5. I'm not sure what you mean by that. My apologies, can be done. I'm going to move on to the Nvidia position though. Another covered call. We've sold the 195 strike for the 20th of March. We originally collected a credit of $850. We had a discussion about how big the premiums were at that time, and that premium has really contracted. So even though the stock's a little bit underwater, we've made far more than that in unrealized gains on that call. Let's go see what our Nvidia history was. So with Nvidia, we bought 100 shares at 183.71, and all along we've been selling calls. Profit here, a profit there, a profit there, a profit here. And this one right now, with this pullback again down to support, could we close this one out and maybe roll out another month. We've been doing it over and over and over again. We've actually, for all of these, this is now the 5th time in a row that we've sold the 195 strike, just a series of 195s, and the stock is just stuck below those. So yeah, Mark says, even though we sold the Nvidia call over earnings, it worked out remarkably well. Yeah, we got to move to the downside, held above support, crushed the value of that call that we sold. Should we do this? Let's go ahead and sell the 195 for April. How much can we get for that? The April 195 looks like it's around $4. It's not $8.50 anymore because it was the earnings. Well, it was the earnings that were increasing the value of that last call that we sold, plus we were closer to the resistance. We were closer to 195 last time. But I think let's see if we can roll this out, maybe get another $3 credit or somewhere around there, closing out the one and getting into the other one. So Nvidia, yeah, it's only about a buck maybe to close this out. Let's right click, create a rolling order. Let's buy back the 195 for the 20th of March, sell the 195 for the 17th of April. It looks like we might be able to get about a 306 credit. Let's say we're willing to settle for as little as $3. And click confirm and send. Selling this calendar, which is to buy back the March, sell into the April, the 195 call, trying to get a $3 credit. There is a commission to get out of the one into the next, bringing the net credit to about $298.70 as a minimum. That'll be our minimum acceptable credit for this order to fill. And we'll see if it does fill. Let's click send, and sold for $310. Okay. So, yep, collected a net credit of $310. So now we've punched this out to April. Right out through there. So I'll update that. So we still have a cap on our upside growth potential for our stock, but we're some distance below that. Charles says, do you keep rolling out the Nvidia for covered call to collect premium? That's the concept here, Charles. This webcast series is all about income, but doing it in a structured way. It's not that we're just selling calls on stocks even if they're misbehaving. We'll make those hard decisions. If a stock is really collapsing, the trader might decide to just close it up because they can lose a lot of money if a stock continues to go down, and it can be difficult to offset that just with the incomes from the premiums. So this one, though, looks like it's still holding at a support. So if the trader still thinks the stock is likely to rise but stay below a certain level, maybe they sell a premium up there. All right. Sherry says, this is way beyond my ability to understand. We all get where you're coming from there, Sherry. Everybody started somewhere at the front end of their own learning curve, especially with options. It can get complicated fairly quickly. I definitely have a suggestion for you, though, because everyone is somewhere along their own personal learning curve. But I did put together a webcast series of lessons for those that are brand new to options trading, and it's intended to bring you along very gradually. We're not what you can see that we're doing today, obviously not terribly gradual. We're making quick decisions, briefly discussing the logic of those positions, but assuming that there's a little bit of a foundation of understanding. Not everybody has that. So here's how to get that understanding. If you're brand new to options trading, come to our channel on YouTube. So you can just actually pop down below the video stream right now and click on the subscribe button. Subscribe. It only takes a second, doesn't cost anything to do that. But we have playlists of previous webcasts. If I go to playlists and I scroll down a bit, what you're going to see, there are a couple of places to find this. Maybe I'll show this way. If I scroll all the way down to the bottom, there's a webcast series that's called Getting Started with Options. So there's my webcast series. If I click on View Full Playlist, what you'll be looking for here in the playlist is the word lesson, and it'll just pop right out to you. You just start scrolling down, and the word lesson will see. I'm going quickly, but oh, there you go. Lesson 8 of 10, lesson 7 of 10, lesson 6 of 10. I would suggest you just start right there at lesson 1, and we start with basic building blocks of how options work. So you just walk through that. All right? There we go. Don't get discouraged, though, if you're not following along with every word out of my mouth right now, because I do try to go at a pace that hopefully everybody can follow, but I realize we can't connect every single dot every single time. So I think that'll help out a lot. Anyway, thank you, Eva. Oh, a little pointer. Eva's pointing out that there's a survey for the live stream attendees. So if you are here in my live stream audience, do me a favor. Click on the survey link that's in the chat window right now, and then fill that survey out when the webcast is over, when you can give me some honest feedback. What I will say, it's a very short survey. There are 2 questions. Then there's a comments box and a suggestion box. But if you take the time to fill that out, I will take the time to read through that. The data, I read through that data. It always helps. I read through your comments. Very much appreciated. All right. But that's it for our current positions. Actually, no, we have Walmart. Walmart is a position that we just took. Actually, we added to this, I think, when was that? Yeah, that was last week. Sold a call for $1.43. That call, we might be able to close out for 31 cents or thereabout. I think I'm going to leave that one on, but here's Walmart. This was a stock that was just sitting in our paperMoney portfolio for a while, purchased for $104.25. And last week we sold a call for $1.43. Break even is way down here. It's not because of the call, though. The call helped out a little bit. The dividend helped out a little bit. But what's really helped is that the stock has just gone up so much. But right now we have a call where someone has the right to buy shares from us for $132, but the shares are quite solidly below $132. It's relatively unlikely that that would happen at this point. So I'm going to just let that position continue to work. Obviously, our hope here would be that the stock starts to climb, get closer to 132. But that's it for our current positions. Let's go see what's going on with these crazy markets. Let's go see the S&P. What kind of a climate is it for selling covered calls and short puts? Well, let me remove this drawing. That came from a discussion that I had just a couple of hours ago. But what an investor or a trader might note is that the last few weeks have been a little bit rough on the S&P. We've been coming down, but today's candle, maybe some signs of life there. This is a little bit of what we might call a hammer. It's not as nice a hammer as it was a couple of hours ago. But when we have a small body on top of a long wick, some traders and investors see that as what's called a hammer candle. But it basically means that we opened here, sold all the way down to there, and then we rallied all the way back up and got above the opening price. So at least compared to where things were earlier today, looking a little bit better. Now, a true hammer, we typically wouldn't see much of a wick sticking out the top. So somebody could certainly take exception to me calling this a hammer. But in any case, on an intraday basis, on a single day basis, we've seen a pretty strong sell-off and mostly a recovery. So maybe that momentum carries prices higher, certainly not guaranteed. But let's just say that that is our income investor or trader's outlook. And maybe in addition to that, they see that there is a previous price floor right around that 65.50 level on the S&P. And we've gotten fairly close to that. Maybe if we go down a little bit further, it's not too much further. However, for some, they might still say, well, if we're going to go down a little bit further, maybe I can get stocks at lower prices. And might wait around, see if we can buy stocks at lower prices. Or we might sell puts that give us the contractual right, or pardon me, let me back way away from what I just said. We might sell puts where we have the contractual obligation to maybe buy those shares, but at lower prices. So I think that's what we're going to be doing today. Now, as we go to sell an example put today for some income, we need to be aware that incomes are pretty high right now. How do we gauge the premiums that are being paid on a wide scale? Well, if we switch from the S&P, which gives us kind of a feel of how the stock market is doing, let's flash over to the VIX, the VIX, which can give us a feel for how the options market is priced. So the VIX is also known, it's the CBOE S&P 500 Market Volatility Index. But basically, it's a chart of how much volatility options traders expect from the markets over the next 30 days. That's going to be kind of the way that I summarize this. Sometimes they expect a lot of volatility. Sometimes they expect relatively little volatility. Now, when the expectations of volatility rise, that will tend to drive additional demand for options. A lot of that demand coming from speculators who see all that volatility as carrying potential. A lot of that demand might come from hedgers who see all that volatility as risk. And both of those groups might use options to pursue potential or to manage risk. All right. So to bottom line this, volatility just hit levels that we haven't seen in 10 months. If we go all the way back to April of last year, that's the last time we saw volatility levels this high. So that it immediately translates to, broadly speaking, higher premiums for most strikes on most stocks across most of the market. Not every stock, not every strike, but generally speaking, these are the highest premiums that options traders have seen in the last 10 months. So if we're buying, we're paying high prices. If we're selling, we might be receiving high prices. So for some, they describe this as being a seller's market. Well, that's interesting because selling is exactly the position that we're looking to take today. So let's do that today. So we have potentially bullish stock conditions with potentially high options prices as an options condition. So I'm going to go sell a put, which is a bullish selling option strategy. But where do we find put candidates? A number of ways that we might do that. You see me demonstrate different ways. Today I wanted to build a custom search, and it's going to include using what we call a technical study filter. Those are only available on the live platform on thinkorswim, so we can't do it here on paperMoney. So I'm going to switch over to my live platform. All right. I don't know if you knew that you could have both paperMoney and live open at the same time. You can. Just open up one and then right click on the icon down here for thinkorswim and select thinkorswim again, and that'll bring up the login screen and you can log into the other one. But when I do that, this is just a personal preference thing. I prefer to use a white background or the light background for my paperMoney while using the dark background for my live. That way, there's no confusion in my mind about which one I'm using, and I don't make mistakes placing a trade that I thought was paper on my live platform or vice versa. All right, so here we are on the live platform. Let's go to the scan tab and let's build a custom scan for a short put. Now, I'm going to run this scan. Let's scan in the S&P 500. Those tend to be among the most liquid stocks in the world. And liquidity can be a problem for options traders. If an option is illiquid, the price the bid price and the ask price tend to skew wide apart. It makes them tough to trade efficiently, right? So another thing that I'm going to do though, and maybe I'll make this point this way. Which ones of the sectors have just absolutely, Timothy says, you just got here, you can't rewind? Nope, this is the live stream, Timothy, so you can't rewind the live stream, but this webcast is scheduled to be added to the archives afterwards. So if you want to stick around with us for the remaining, 17 minutes or so, if you want to watch the first 28 minutes, you can just wait a little while. Might be a couple of hours, might be longer. It just depends on how quickly we can get that thing posted. But then you can just go watch the rest and get caught up. Anyway, but there's a specific sector that's really been taking off. I think a lot of you are aware of the escalation of tensions that we have in Iran. So Iran has threatened the shipping lanes that go through the Strait of Hormuz. Anybody trying to move oil through the Strait of Hormuz right now is under threat of attack from Iran, So those lanes have just shut down. That's about 20% of the world's oil supply that just has come to a halt. Inventories are starting to build up, but options price, pardon me, oil prices have really taken off. If you've looked at that today, whew, my goodness, we've gone from oil prices that very recently were $55 a barrel, touched almost $120 a barrel per day, or not per day. I keep slipping into options talk. Anyway, per barrel, and that means the energy sector, which has already been hot, has just, boy, it's really been taking off recently. You can actually see that. Let me type in the energy sector symbol here. So that's SP 500, and I believe it's the pound 10. Yeah, that's our energy sector right there. And you can see that the energy sector has just been heating up like crazy, to forgive an unintended pun. Let's filter that out. Let's just say that our would-be income investor might think, okay, is this a little bit overheated? Time will tell. But I wanted to show that this can be excluded from a screen. So let's look in the S&P 500, but let's exclude we go down by industry, and let's just do the whole energy sector. All right. So we're going to be looking through the S&P 500, excluding energy, for potential put income candidates. So now let's start to build a search. Now, for options traders, as I mentioned earlier, liquidity can be a big deal. We've already filtered for liquidity to some extent by looking at the S&P 500 exclusively. But let's say that our would-be options trader also has a market capitalization requirement for their stocks. Stocks that are very large companies tend to have more liquid options. How about we set a minimum of $100,000 million in market capitalization? In other words, we're setting a minimum of $100 billion companies that we're looking for here. That's going to be our first criteria. Our second criteria is going to be price. All right. Price can be selected in a number of ways. Let's just say the mark. If you're not familiar with that term, on thinkorswim, mark stands for the current market price of something. And let's say that we're looking for stocks in the S&P 500 outside of the energy sector, $100 billion companies priced between, I don't know, how about we say $50 at the minimum. Charles says, why are you excluding energy? So Charles, I just went through that logic, but it was basically because energy has been going up so quickly. If we're in a new bullish position, if it can't maintain that momentum and collapses, that can create a lot of downside risk exposure. That's the concept. Now, am I saying that energy is about to collapse? Nope, I don't have that insight. I mostly used as an excuse to show a filter capability on thinkorswim. Can you forgive me for that? All right. But let's put in a minimum stock price of $50, and maybe our investor doesn't have really, really deep pockets. So let's put in a maximum of $300 for the price per share. Our next filter, this is where I don't even need this stock filter. I'm going to take that one off. And let's now use a technical filter, a chart filter. So that can be found right up here. We're going to add what's known as a study filter. And I'm going to specifically require that price is doing something. Here's the thing. It's been a rough last couple of weeks for a number of companies. Now, obviously, the energy sector is kind of an exception. There are a lot of companies doing very well in that sector. But let's say that among the rest of the sectors, let's say that our income investor is still looking for those that appear to be relatively bullish on their chart. So not those that have been coming down and down and down and down and down. Let's do a price performance requirement that we are still near annual highs. So the price performance study filter that says near high lows, we can look for stocks that are trading near highs or stocks that are trading near lows. And how about for today? Let's say within, I don't know, 8% of 252-day highs. Why 252 days? 252 days is basically the number of days in a trading year. So what we're telling the system here is We want to see these $100 billion companies priced between $50 and $300 that are still up there fairly close to their highs. So they're not in collapse mode, or they haven't just been selling off for a long time, still within 8% of those highs. And let's run a scan and see what we get. All right. So it looks like out of about 500 companies, we chopped away the energy stocks. We chopped away anything under $100 billion. We chopped away anything below $50 or above $300. Also have eliminated anything that has come down more than 8% from their highs. That leaves us with 20 stocks. So let's have a look at these. Have a look at Johnson & Johnson right there at the top. Right now, these are just organized according to which one's the biggest. All right, the biggest is probably the most liquid. I can't guarantee that. But if we go look at a Johnson & Johnson, how's it doing in this market that's been somewhat struggling? Johnson & Johnson has just been continuing to climb, and we don't actually have a position in Johnson & Johnson. I think let's use this one for our next income candidate, okay? So how about we look at, let's maybe sell a put. Can we still get a decent premium out there just here in March? That's only 11 days from right now. Today's the 9th. The 20th is just 11 days from today. Looks like we've recently come down to lows around 235. Wonder what we could get if we got into a contract right here at 235. Let's carry that out to expiration right about there. Let's go to the trade tab. Let's go to the March contracts. And I got to check current prices because I don't know. 235, we could sell a put. Looks like between, $1.75 to $2.17. So we might be able to get this for, let's say, $1.95, somewhere in the middle. Let's let that be our trade for today. Okay. So our example trade is going to be a short put. And we're going to sell the 20th of March. Let's get the M in there. 20th of March, 235 put for, let's say it's $1.95. We don't know until we place the order, and if we can get it filled. Don't know exactly how much this could be. Pardon me. But what exactly are we getting ourselves into? What is this trader doing to themselves? Well, the motivation for this trade is to collect $1.95 per share, $195. Now, in doing that, they're entering into a contract for the next 11 days where someone has the right to sell shares to them for $235. So they better be okay with buying shares of Johnson & Johnson at $235 because that's a possible outcome. Okay, Prakash says, do you use Greek? Sometimes we do, Prakash, in this webcast series. Today I use the chart. I just looked at recent lows. For others, they might look at probabilities using something like delta. Delta doesn't only tell us probabilities, it can also tell us how much we might make or lose on a $1 move in the stock. But for today, we just looked at charts. We thought, hey, looks like recent lows have been around 235. So if those lows hold, and if the stock goes up, even if someone has the right to sell us shares for $235, are they likely to do it? Nope. If the stock is worth $235 and we hit expiration, it's very likely this contract just expires worthless and we pocket the $1.95 or $195 in income. If the stock does stumble, let's say that it comes down here below $195, we might get assigned those shares. That's why the trader needs to be comfortable paying the prescribed price for the prescribed stock. If we don't want these shares, this is not the strategy for that trader. Dan says, do you look for a 1% trade? That's a number that I commonly reference, Dan. It's not a requirement of every trader. I don't explicitly state that as a rule, but for some, they look for, something at or in the neighborhood of 1% as a general guide. And you can see 195 It's close to 1% of 235. It's not quite reaching that. Sam says it's a pretty risky trade. Welcome to the world of selling puts, Sam. Yep. Yeah, there are definitely risks associated with this. Is it pretty risky? I don't know. It depends on the trader's preference. If they don't mind buying the shares at that 235 level, or even maybe they wanted the shares and they would be totally fine if those shares were ultimately put to them. That might be their objective. Yep. But there's certainly risk associated with selling puts, because if the stock does this, let's exaggerate things. We don't have like a big scheduled event that might cause this, but something could pop up at any time. If the stock collapses in value, but our trader has the obligation to buy shares for 235, they may be way overpaying for those shares. Risk is certainly present. JDLMI says it requires buying power. It does tie up funds, no doubt. Yep. As a matter of fact, it ties up the same amount of funds as if we had done a covered call on the stock, depending on whether one's doing it in like a margin account or an IRA. But yeah. So let's go do our trade though. Let's go to our 20th of March, 235 put. I don't know if we're going to get $1.95 out of this. The price seems to have come down a little bit. But let me click on this. Let's just do one contract. It's an obligation to maybe buy 100 shares. And let's say that we're willing to settle for, let's try to squeeze $1.80 out of this. That's halfway between the natural and the mid. And let's click confirm and send. Selling one J&J 20th of March 235 put for $1.80. That's the minimum that we'll accept. If we can't get it, it doesn't fill. There is a commission to be paid that can chip a little bit into that minimum acceptable credit. Let's send that order off. There we go. So we'll see if that fills. I'm going to let that one work. But we've accomplished what I set out to do. Oh, it did fill. We got $1.89. So if it's helpful, we can put that on here. $1.89. So we just put $189 into the account, but that came with an obligation. For the next 11 days, this trader has the obligation at someone else's discretion to buy 100 shares of Johnson & Johnson at $235 per share. Right now, with the price above $235, that's not currently likely. It's still possible. It becomes more likely if the stock falls down to, or increasingly more likely, below $235. All right. But guys, we are going to talk about this trade more in the future. So I hope that you'll put it in your calendar to join us in the coming weeks as we talk about the management of this position. Next week, it's going to just have a few days left on it. We'll see how it's going and what might the trader decide to do at that point. But the emphasis of this discussion was to show how might we build a quick search or a scan for things like selling puts. And we've done that today. I hope that was helpful for you. Everybody, thanks for giving me your time today. Time for me to let you go. But I want to make you aware of the full slate of educational resources available to you from Schwab Education. Hope that you're availing yourself of everything. Starting with, make sure that you have subscribed to our Trader Talks channel on YouTube. If this is your first time in my webcast series, welcome. It's great to have you here. But make sure that you can pop down and click on the subscribe button just down below the video. It doesn't cost anything to do that. It only takes a second. But our Trader Talks channel on YouTube is where you can join our live streams. You can find playlists of previous webcasts. So for example, if you want to find the playlist for this webcast series, you click on playlists right there on the channel homepage and scroll down kind of toward the bottom, and you'll see covered calls and short puts right down here. Click on view full playlist, and you can see last week's episode and the one before that and watch those. And like someone joined us today a little bit late, this is where you'll come to catch up. Now, another thing that Barb and I would suggest is that you follow us on social media. You can follow Barb and me on X. You can find and follow Barb there at Barb Armstrong CS. You can follow me on X at Cameron May CS. But social media is the way to connect with your Schwab presenters in between the live streams. And if you reply to one of my posts, like this one that I made about oil prices earlier today, I just write a reply right back to you. Now you can also find and follow us on LinkedIn as well. So my profile can be found. You just go to linkedin.com/n and then /Cameron May CS. Barb, you'll have to correct me. I don't know yours just yet. We're quite new to LinkedIn, so you just go to, I would believe, linkedin.com/n/Barb Armstrong CS, but I don't know. Barb, you can correct me on that one. Finally, there is a survey out there in the chat for the live stream audience. So if you'd click on that survey link again, Barb has reposted that. Thank you, Barb. But just fill that out. It's only 2 questions, a comments box, and then a suggestion. So 2 questions plus a comments box and a suggestion box. If you fill it out, I'll take the time to read through that. It's never a wasted effort. Thanks for all the thumbs up, everybody. I've got 149 people watching the live stream right now, and I can see 68 already gave the like or the thumbs up. That is very much appreciated. It's like applause for your presenter, and it gives me a boost in the YouTube algorithm, helps more people find the video. All right. Yeah, Dan says it took you 20 seconds to do the survey. Thank you, Dan. Appreciate it. Everybody go have a great day. I will see you in a future webcast, including in this webcast series, maybe next Monday. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.